Okay, so why don't we start? Give me a thumbs up if you guys can hear me well, if you guys can't hear me. Um, I wanted to do an AMA because there's a couple of things on my mind right now, especially as the business is changing. Um, we believe in content strategies here, in my business, meaning, once you have an investment concept, an investment to make, can you devise a piece of content that can help you really maximize the opportunity? It's one of the hidden aspects of great investors that they just never talk about. But if you don't listen to what they say, but you look at what they do, they often have these unbelievable, very smart and tailored content strategies. And like Napoleon said, his printing presses won him more battles than his sixth infantry. And there's a reason for that. So couple of things on my mind, then I'll go in and answer your questions. So the first thing is, after you have all these AI tools that are proliferating in the investment business right now, investors still haven't changed their stock selection criteria. If you ask any investor today and you say, what do you look for? They say high quality business, great management team, a moat, long runway for growth. Oh, and by the way, we want all of that with a margin of safety and the stock has to be cheap. You know, you might as well say that you believe in unicorns at this point because in the 70s and 80s and even 90s, when value investing wasn't that well known, you could find these things. Today you have 5,000 books on value investing on Amazon. You know, it's pretty well known that businesses with high returns on invested capital and the moat will outperform. The question is, can you find them at a cheap valuation or when they're going through a problem. And even that, there's a lot of very, very smart people, believe me, way smarter than you and I will ever be, that are looking for these things. And the market structure also has changed. Today you have new entrants in terms of the algo firms, quantitative firms, the passive, the pods, and they have a lot of resources that are applying to what we do. And in fact, not only do they have better data, but their quantitative and even AI tools are way better than what's out there. So how can you still find a differentiated advantage? They're out there, okay? They're rare, but they're out there. Look for those. Um, the second thing is, amidst all of the um, development strategies, no one is really focused on, the transition that's happening right now from the baby boomers to the Gen X to the millennials and then to the what we call the Zoomers. And we call this the boomers to Zoomers theme. There's a big, big change happening. Okay. That wealth, actually, you know what? Let me just show you because you can see it. Let me share this. So that wealth is trickling down as the first baby boomer is turning 80 this year. January 1st, 2026 was the first time the baby boomer became 80. And sadly, they are passing. right? And as they are passing, their wealth is going to their wives, and or it's trickling down to the Gen X guys, it's trickling down to millennials, and it's trickling down to the Zoomers. And we call that the generational battle. Why is it a battle? Well, because there's these Zoomers today and millennials and younger millennials are receiving a lot of cash and they're going out and investing it into the marketplace. Now, who is going to have a competitive advantage? It's really interesting to think about, by the way. The what are they investing in? There's all sorts of behavioral advantages that you can derive by just understanding this theme and this dynamic. And and again, by the way, talk about differentiated stock selection criteria. This is something that's important for us. We look for themes like this, themes that are not being um, that are not widely recognized by the investment community. I mean, don't get me wrong, there's plenty of themes out there that are widely recognized that are fantastic. This AI CapEx build out trade is unbelievable. And European defense is going to continue to be interesting. US defense will continue to be interesting. And there are both thematics, what we call, what most investors will call tailwinds, both on the long side and the short side. But it's very important to understand this. I keep talking about it in terms of themes, but I don't think it's registering out there. But in case, make sure that you guys understand this dynamic and what is going on. The third I would talk about is handling stress. Okay, because again, I look at my peers or people that are younger, and just to step back, I just read a statistic that really highlighted something for me. What percentage of people that were running money in the early 2000s do you think are still running money today? I saw a stat on that. And by the way, I'd like to prove that out, but it came from a source that I trust. It's actually 5%, right? So in a close to 24-year period, only 5% of people that were running money back then are running money today. Now, I'd be willing to think that this is going to accelerate. If you look at the rate at which people last at the pods, for example, they don't last that long. At other hedge funds either, and it's gotten, almost people have normalized the fact that people don't last in our business. And I think one of the reasons, by the way, is handling stress. So, if you guys, learning how to manage stress, to handle it, and also to condition your life so that you can handle stress. There's a Russian billionaire that I really respect. He says that his competitive advantage is handling stress. And if you study like all the ways that he does that, they're really interesting. But it's what he's gone through probably highlights that in a big way. Anyways, so those are the three things that are really on my mind right now. There are others, but ask away. No question, every question is welcome, really. If I can't answer it, I'll just tell you that I can't. I have some questions here on the Zoom, and I have some questions on the YouTube. And I'll just start checking, but again, don't hesitate. That's a good question. So, somebody on the Zoom here is asking, whom do I respect as an investor? Um, I mean, there's so many, the um, hmm, I'll mention a few. Um, Ricky Sandler at Eminence Capital. I know he just shut down, but again, talk about somebody that has lasted. Ricky did this for I think Eminence was 26 years. I've known Ricky since the early 2000s. We met playing poker actually. Um, and forget his accomplishment and the returns that he's put up in a 26 period, but he's a really, really good guy and really well surrounded. One of his early lieutenants, Seth Rosen, was also an incredible person, is a dear friend of mine. They're really, really good people. But I remember, I'll tell you guys a story on Ricky. I worked at a family office, and the family controlled a bunch of beer assets all over the world. And at one point, Ricky asked us for a meeting, and I brought my principal into the meeting, who was basically the person controlling this beer company. And Ricky came in, and in a 90-minute meeting, he blew us away with how much he knew about the beer business. This is back in 2002, right before there was a massive consolidation period in the beer space, and we were blown away with his knowledge. There were other times where I pitched him stuff, and even in his giving me feedback as to why he would not invest in it, I would learn. So I think Ricky is somebody I really respect in our business. There's a second person, well, I would say two people, but sadly they are very private. But they're people, they live in LA. It's a husband and wife. They run really mostly their own money. And the returns that they've put up over the decades are just incredible. But also, something that they've done is President Trump just passed the Trump Savings Plan, which is a plan that gives every single American a certain amount of cash invested in the stock market. That whole plan was designed by this couple out in Los Angeles. And if you know them personally, they have a generosity of spirit. Like that's literally palpable, but also you can tell that from their friends. But at the same time, the fact that they, for probably 8 years, worked on this policy change and were able to implement it through the government so that that generosity seeps through to almost every American, that's actually really cool. I mean, there's so many investors I respect, but one thing I'll add to that question is all these investors tend to be very unique and they're not afraid of being who they are. Yeah, they might generate an idea from somebody else, but once that idea becomes their own, they add their own personality to the idea. And this is actually should be another topic of conversation, which is the importance of personality typing in investing. I'm a big believer in using personality typing in investing to either select people or to understand somebody's thinking. And it's going to be a very important part about self-awareness is just knowing who you are. By the way, the not to get in too much into this debate that's going on right now between the I would say the Mark Andreessen rumination versus retard maxing. Um, and I think some people have unfairly criticized Mark. In a way, Mark is right. You shouldn't ruminate too much on your mistake. You should learn from them quickly, but then move on. But I think a lot of investors, and that's also what's causing the level of attrition that's going on in the investment business right now, is they make a mistake and they'll take out a whip and mentally, whip themselves because they made a mistake. A dear friend of mine was telling me the other day that he made a mistake, and for 2 days, he was upset about it, and then he looked how much the mistake cost him. It was 5 bips. To beat yourself up over 5 bips is a little bit too much, but I think we tend to do that. So I think introspection is important to understand yourself and to learn from your mistakes, but don't ruminate. Don't spend hours beating yourself up. Um, so let's that's what I would say about, investors I respect, and again, the importance of personality and really highlighting, your what makes you unique, and then taking that and applying it to investing, embracing your own funk, as a friend of mine would say. Okay, let's answer some questions. Thanks, Evan. Um, Analog trading is important. Um, okay, BlackRock dominating ownership. How has corporate governance changed? Have passive investors crowded out activists, and how does that affect how you assess management accountability? It doesn't really affect it. Um, you know, a, a lot of corporate governance, um, it's really still the same. But I would say that it hasn't really escaped certain CEOs and boards that the index funds um, are a different kind of investor. The other thing I would say also in terms of crowding out activists is the activists today, except for very few, tend to be much shorter term and what I would call drive-by activists than usual. Hold on, let me stop sharing this because you guys don't need to see this anymore. So the in terms of management accountability, we look for management ownership. We look for boards that are talented and also understand governance. If you guys haven't read Mason Morfitt's and Value Act's piece on the board book, I think it's very important to understand. Some of our research when we research boards is if we get access to a board is, we kind of want to understand how the board gets information from a management team, and then how they have a strategic conversation at the board level that can then set certain policies for the management team. Boards have different sub-boards. So there's governance, there's audit, there's compensation. And it's very important to spend time on who is on the compensation committee of a board, because in many ways, that's really who has the power. Um, and there's a lot of, I've known a lot of board members in my career. Um, and I actually enjoy speaking to board members more than I enjoy speaking to management. By the way, they're all pros. They're never going to disclose anything. And I mean, it has happened that we've locked ourselves out of a stock and we're restricted. But we're pros too, and we check with lawyers. So in terms of, I wouldn't focus too much that on the passive having changed things. Believe me, when a business goes through a problem, the quality of the board is going to matter a lot, and that's something that you need to understand. The other thing, uh, key shareholders matter a lot more now. So, there are people that no longer like activism, they like suggestivism. So you kind of need to track who are the shareholders that can give, that are really good at giving advice to a management team. There are shareholders that are that good at understanding a business and that can speak to management almost strategically about what's going on, and also serve as a tool for management in many ways. Okay. Best way strategies for raising capital is emerging long only, but with okay but not Tiger Cub pedigree and a great 3 to 5 year performance and good technicals, sharp Sortino. Great question. You need a content strategy. Okay, that's the first thing that I would incorporate in your capital raising. There's four forms of leverage that is non-recourse, and I actually have a piece on that. If you haven't seen it, please watch it. Some years ago, I got asked to to speak at Yale University, and I spoke on this topic. There's four main forms of leverage: capital, code, community, and content. So capital is what you're trying to do, which is you're trying to raise capital. Like, so for example, for every dollar that we raise, we get paid a management fee and we get paid an incentive fee. And we're levered to that capital. If you think about Mr. Buffett, he's levered to all sorts of capital, including float, insurance float, that he takes in. And by the way, because he's a good handicapper, he takes it in and almost charges a fee for taking that in, then invests it in stocks and earn return on invested capital on that, and he's levered to that. It's a very powerful form of capital leverage. Uh, but there's also intellectual capital, right? That you're levered to. The second is code. So code can actually be software. Think about what we're doing right now. I'm using Zoom, which is a piece of software to speak currently to a lot of people. We're recording it. The software allows you to lower your cost and to extend your reach. A code is a piece of software. Think about what AI is doing. In many ways, AI is the ultimate form of leverage because it's actually reducing the cost of that software, which is fascinating. Uh, Community, which is the third form of leverage. You cannot accomplish your investment goals without a community of smart analysts, smart portfolio managers, or investors, a community of investors that believe in you to actually give you to give you money to invest, right? But then the last form is very important, which is content. And for example, what I'm doing right now, we believe in having content strategies because why? Because you can have a piece of content that you use code and capital to share with the community. So, what is it about your long only and you've got great returns? You need to get more investors to know about you. How do you do that? Well, you got to have a great content strategy. Okay. And I recommend that you study content strategies. There's some do's and there's some don'ts. We studied it for over a year before we started implementing it. Um, um, the second, so having a content strategy, that's the first thing. The second thing is, how many meetings do you do for your marketing? It's funny, we're going to start marketing this year. Um, and it's kind of unbelievable the success rates of marketing, how low it is, So if somebody told me if you meet with 100 investors, you should expect maybe 3 to 5 to invest if you're good. Imagine that rejection rate, knowing how to handle that. The third thing is, do you have a distribution platform? Is your prime broker helping you raise capital? Do you have a third-party marketing firm helping you raise capital? Are there relationships of people that you've made money for by sharing your stock ideas with that believe in you, that know you're a money maker, that are going to invest with you? The marketing, by the way, is a massive competitive advantage. People tend to focus on competitive advantages as, analytical where you analyze better than somebody else, or informational where you get better information than somebody else, or behavioral where your investment behavior is better than somebody else, or you can exploit the uneconomic behavior of other market participants. But fundraising is an advantage. And believe me, there are some really, really good fundraisers out there. Take an investor who I really respect, Bill Ackman. The guy's an incredible marketer, incredible marketer. So really studying marketing. Have you read Ogilvy's book on advertising? Both of them. Have you read books on writing and how to create a content strategy? This is very, very valuable skill, but fundraising is a competency, okay? You have to spend the time studying it and practicing it. And I actually believe that it's continuous. The kind of fundraising that we've chosen to do is because my business partner is a businessman. He was the founder of a very large insurance company. We've chosen to raise money and majority from other business people like that because I start from the opinion that I am a total moron and I don't know shit. So I want to surround myself with very, very smart business people that have knowledge, contacts, and ideas that can leverage. We're way greedier than most. We don't only want their capital, but we want their intellectual capital as well. And having great partners is very comforting, I think. Um, because I think in the investment business, you think of the person that gives you the money as your client. That's not your client. That's your partner. It's different. We don't have clients. We have partners. We think actually our customers and our clients are the investment professionals or counterparties that bring us great investment ideas that we can make money from. But the people that invest with us, they're our partners. So how do you become a great partner? My business partner, he has a meeting with his family office where on a weekly basis is they really say, hey, how can we add value to our partners? That's really cool. So you need to be able to think at that level. Hey, by the way, no name Felix, if I haven't answered your question, please ask, keep asking, by the way. By the way, in terms of Sharp and Sortinos, that stuff, of course, is important in retrospect. Um, but make sure that you really understand the qualitative dynamics that are going into your portfolio as much as the quantitative dynamics. Okay. C Weekly, thank you. I appreciate that you appreciate our content strategy as well. Okay. So can you talk about managing your own capital versus OPM? So it's interesting. I actually like the constraints of running other people's capital. Um, uh, we have I used to have an outside fund. Now everything that I do, a personal fund or a PA, but not everything I do is in the fund. And our returns were good back then, but our returns are better now because I like the constraints of somebody overlooking my shoulder, right? My business partner, for example, sees everything that I do, and he's an incredible coach. He's like, hey, why are we in this? And then you look at this and you're like, well, I haven't thought about this in months. Why are we in this? And then, it forces you to re-underwrite something. But by the way, personality wise, I'm an extrovert, right? So I'm going to like those constraints, right? Whereas if you're an introvert, you shouldn't necessarily, you probably would do better if you only ran your own money. The other thing as well is, of course, I like to be levered to other people's money. I mean, who doesn't? And I understand people that once they reach a certain level that they want to do it. But me, I think it's also a very self-renewing thing. When I meet somebody that might be a potential investor, and like for example, on Saturday, I was at a friend's party, and I met this young investor. I'm like, this kid is fucking talented. That I want him as a partner because the things we're going to learn together, the way he looks at things, it's refreshing, it's renewing. And by the way, one of the investment criteria we have is we look for companies that have internal renewal processes. In the old days for Nike, for example, it used to be the young athletes that they took in, where they would allow the young athlete to have an input on the development of shoes and other things. And that was self-renewal, and it was self-renewing. And great partners can act like that. And that's the reason why we like to run other people's money. By the way, the other thing in terms of the way that we defer, I think I was way more concentrated when I ran just internal capital. But now that I have a partner and it's mostly his money, we run more diversified. But I actually believe in running more diversified now than I believe in running concentrated for a bunch of reasons. The other thing is we also run long short. So we've chosen our portfolio construction to be differentiated than most. It's also it fits my personality type, our portfolio construction. And again, think of a portfolio like a boat. There's some guys that are good to run cruise ships. There are other guys that are great to run speedboats. There are other guys that are great to run shipping boats. Your personality and the way that you run your portfolio is very important. Um, Hope I answered your question. All right. I believe you mentioned technical analysis in the past as a sort of useful tool for PM, though not always disclosed as such. That's correct, Felix. We Technical analysis is the mistress or the lover of PMs that they don't like to talk about. Um, and there's reasons for that. By the way, if you read the old school investors like Druckenmiller, Bruce Kovner, technical analysis is very important, you know. But it's not important in isolation. It should just be something else that you add to your mosaic of things that you look at. If a business is improving its fundamentals, but yet the stock doesn't reflect that, you need to look into that reason. Why is that? It could be that you found something where the business is getting better, but yet the stock doesn't reflect it yet. But the technicals, there's other investors out there. The market isn't stupid, right? If something is happening in your business where things are moving and things are getting better, odds are an investor out there or a group of investors are seeing that they're bidding up that stock, right? So it's important to understand it, but you don't really need to understand, to read books on technical analysis. Now, really understand moving averages and is specifically the 200-day moving average. If it's above or if it's below. If it's above the 200-day, understand that anybody who's bought the stock in the last 200-day is making money. If it's below the 200-day, anybody who's bought the stock in the last 200 days is losing money. So if you're making money, how are you feeling? Pretty good. If you're making a lot of money, how are you feeling? Well, you might actually be cocky and you might also be complacent, right? So there you can actually double check on the fundamentals to see, wait, are they being too complacent? But if the stock is below the 200-day, you're pissed off. And by the way, so are the employees usually, right? There's an investor I love and respect so much, but he hates to be mentioned. He loves this saying by Heraclitus, where he says, "No man ever steps in the same river twice, because it's not the same river, nor is it the same man, right? But companies as well. When a stock has gone up 5x, and especially if it's a stock with heavy stock-based compensation, do you think the employees have changed? Do you think management has changed? These are very important things that can tell you a lot about the culture of the business at a time. So me personally, I actually believe that when a company's moat is expanding, right? This is something, one of my core beliefs about investing, which is moat expansion. When a company has a competitive advantage, a moat, something very difficult to replicate, and that is expanding and it's getting denser, the stock price should reflect that. It should. If it hasn't, you need to really understand why. And often in that why, there's an opportunity. But I'll mention something else. Value investors have a fetish. And the fetish is they hate buying a stock that's already working. I never understood that. It's not where the puck has been, it's where the puck is going, right? William O'Neill, who wrote a book called what's William the How to Make Money in Stocks, which by the way should actually be read by the investment community, but it's kind of been abandoned for many reasons. I think part of the reason it's mostly associated with retail investors because O'Neill owns Investors Business Daily, which I think is very unfair. He makes the point that in a study, only 2% of investors are able to buy great stocks that are trading at a high and that are doing a recent high. But if you actually think about it, the best stocks of the last 30 years were almost always making new highs. They go through drawdowns for sure, but are you able to buy a stock that's making a new high? That was one of the first things that I corrected in my investment style, which is that I needed a stock that was down before I bought it. No, we don't do that anymore. But those are on the contrary, actually. If a stock is down and isn't working, odds are there's a reason why, right? If a stock is really cheap, it's cheap for a reason, and that reason often isn't good. And when that reason is turning is when you have to really understand it. I really appreciate your take on strategic reading. Thank you, JVF. I'm curious to know what is your take on using AI for learning? Oh, uh, so if you're younger, we are not fans that you're using AI for learning. Not fans at all. Um, if you're younger, I want you to use a 10K and a pencil and learn how to do constant reps and repetitions on 10Ks and pencils and applying value principles, but get into the habit of reading a 10K and then try to understand the moat of the business, how to value the business, the competitive dynamics that the business might be going through, and use your mind to be able to do so. The Ethan Coe just did a podcast with with uh, uh, a researcher analyst. I'm blanking on the guy's name, where he says, why don't we learn to walk into the room before we run into it? And giving young people these AI tools, they haven't developed the context, the mental models, the principles, the reference positions to really use these tools well. And I'm a bit concerned for the development of young people. By the way, in many ways, competitively, I'm ecstatic about it because those are the people I'm going to be competing with in the next 20 years. But I'm a bit concerned that people have abandoned their judgment to these things a little bit too much, where they may know something, but I don't think they understand it. right? And understanding takes experience. The principle that you guys are looking for, or I guess as a mental model, is data hierarchy. It's from Russell Acuff, which if you guys haven't studied, it's a must to study. Acuff uh, was a systems theorist. I think he was at Penn, and he's the theorist that everybody loves to quote but not give attribution to. I'm not going to name the guys that I know that have quoted him, but I'm like, yeah, you studied Acuff. You just came out with it as if you said it, but I know where you got that from, motherfucker. But Acuff says, okay, you have data hierarchy. And believe me, let me nerd out a second on this because it's very important. And I think it's going to become more important in the age of AI, is that the world is full of data, but 1 ounce of that data is information. And information is already a lot. Think about how much data there is, but 1 ounce of that data is information. But 1 ounce of that information is knowledge. And think of knowledge as a procedure, right? A process, something that, like, for example, a doctor, for example, the data and the information that he needs to turn into knowledge is very different than an aeronautical engineer or an investor, right? But what is that knowledge? It's usually a way of doing things, right? But then an ounce of that knowledge is understanding, right? And an ounce of that understanding is wisdom. So data, information, knowledge, understanding, wisdom. But what gets you from knowledge to understanding? It's experience. It's, hey, I tried this and it worked. I understand it better, right? So knowledge plus experience equals understanding. But what gets you from understanding to wisdom? Well, it's in a way, it's understanding plus more experience. And the experience, I call it network experience. Like if you understand something and you try to teach it to somebody and that person doesn't get it, and you're like, why doesn't he get it? Oh, and you realize he doesn't get it because it doesn't fit his personality type. Well, now you're wise in understanding that this person will never understand this because it's not his personality to actually understand it, right? Well, I actually think that AI tools are removing experience. Does it matter more that you're able to go and use the AI tools, or does it matter more that you speak to customers and really understand why they love a product? Right? One of the principles that we look for is something that we call the 9 emotions. We think that businesses that have an emotional relationship with a customer based on 9 emotions are more valuable than others. The 9 emotions are vanity, greed, lust, fear, relief, addiction, nostalgia, novelty. And I always forget the ninth one. And envy, right? Think about Instagram. Instagram is literally all 9 of these emotions, whereas an airline is, maybe relief that you're getting off of it because airline experiences mostly are terrible, right? So the AI tools, I think give you a false sense of security that you're developing fast, but really you need to, if you're younger, do more analog training. I personally do not allow the younger guys on my team to actually use them. Sit down, read, think about things. Once you understand something with 10K and a pencil, then go use the tools. And by the way, it's the way that they train special forces. Do you think they give them the highly sophisticated weapons that we just used in Venezuela from day one? Or do they drop you in the jungle with just a knife and and your wits, and you say, dude, you got to survive for the next 2 weeks. Oh, by the way, while you're trying to survive, we have a team of pros that are going to be fucking with you just to see if you can handle it. And then once you go through that sort of training, then they add those weapons on top of it, right? And I actually believe that AI tools are are dangerous for the development of young investors. Um, by the way, Felix, if I haven't answered your question, uh, I'm sorry, JV Fontanille. Please ask it more, but I hope I did. I'm interested in what's your framework to approach CA from the perspective of fundamental long short PM. Of course. So we don't short something until the chart is broken. I refuse to short a chart where the stock is like this. Well, actually, in your perspective, basically, I refuse to short a stock that's reaching new highs usually. I want this company to have missed earnings for the first time, and the stock is in what's called in distribution mode, where people are like, wait a second, there's a problem. Because when a stock is going like this, people are asking bullish questions and getting bullish answers. Okay. No one, the short sellers are shorting it. They're losing their shirt. They're probably getting fired. They show the PM their work and they're saying, well, I think I'm right. Meanwhile, the market thinks you're wrong. The bulls literally don't care about your short case. But then the first time the company admits to a problem, we prefer to short after that. So both in conjunction with technical analysis, the chart dipping and the fundamentals deteriorating, that's usually the sign that we want to short. Same thing for the long side. We prefer when the fundamentals are getting better and there's almost like an inflection to the positive. Speaking of, one book you guys need to read that is not widely understood today, but it's going to matter a lot more, is Andy Grove's Only the Paranoid Survive, which no one has read. And even there's no people that have not read it say that it's about paranoia. It's not about paranoia. It's about strategic inflection points. It's very important to understand when a company is going through a strategic inflection point. Okay, very, very powerful. And it shows up in the chart, it shows up in the business. And by the way, companies go through positive strategic inflection points and they go through negative strategic inflection points. Okay. And great analysts, even like really good analysts sometimes miss when it's happening. And actually, the point that Andy makes in the book is that management teams themselves often miss that a strategic inflection point is going on. And by the way, AI, with the change in industry structures that it's causing, there's a lot of management teams that actually don't understand what's happening. We saw this the first time during Internet 1.0, when the newspaper companies were competing against the new found internet businesses. But today it's happening, but in an accelerated way. So uh, uh, strategic inflection points are going to show up in the stock price. They usually show up there first, by the way. Okay, if you were to create an AI startup to help retail investors, anything equity invested related, what would it be? I don't really know. There's some really good stuff out there already. It's going to be hard to, we did something cool the other day. Well, the other day, we've been doing it for a while now, I guess. So one of the best investors in the world gave me his checklist. And we took his checklist, put it into Grok and said, Grok, answer every question in this checklist. Uh, and Grok comes out with a memo that's just like, wow, that's a really good job that it did. And then we said, okay, answer these questions as if you're Charlie Munger. And it answers them. Answer these questions as if you're Warren. It answers them. Answer these questions as if you're Peter Thiel. it answers them. And with each perspective, it was like it got it. By the way, a lot of blind spots, some things you had to refine. Grok, we said, use Clayton Christensen's Innovator's Dilemma here to analyze what's going on. Use Hamilton Helmer's Seven Powers, use Porter's Five Forces, and so on. But it's actually pretty good, right, to use these tools because, again, think about it. Grok, Gemini, Claude, ChatGPT, they have access to great computing power, a lot of data, and some of the most sophisticated algorithms. It's going to be very hard to build anything, even on the retail side, that comes and replicates that. Um, if it was me and a friend of mine is doing this, it would be something that educates investors more than it shows them how to analyze things. Examples of funds with best marketing content strategies. Um, my friend Dennis Hong has these investment memos that he only shares with partners or potential partners, and each one of them are better than the others. They're so thoughtful. And he'll meet with you and say, "Hey, read my memo on this." And the memo, like, I have to give this guy money. The memos on the businesses are so detailed, and it shows both his judgment, the proprietary work, and he has this concept called ecosystem control, which is actually a refinement on Michael Porter's work and Hamilton Elmer's, and he came up with this concept by himself. Phenomenal stuff. Who else? If you're lucky to have read his letters from inception till today, and I no longer get access to them, but I used to, Larry Robbins. Larry Robbins, in his early years, went through a period of underperformance, and every quarter he would write about the things that he was doing to learn from what he was going through. And every one of them was like, "Yep, I'm learning from that. I'm learning from that. I'm learning from that." Andreas Alverson at Viking, whenever he would go through a period of underperformance, he would write a letter saying what he learned. And we call these the Viking mea culpas, where okay, Andreas just went through underperformance, so he's gonna write something, and if we get access to that letter, we're all gonna learn from it. It's literally these letters where I have an image of this Norwegian Navy SEAL writing the letter and him getting whipped on the back as he's writing the letter because he's literally pouring his mistakes on a page, and you're learning from it. It's very thoughtful. By the way, apparently Viking PMs over the decades have all written mistakes that they've made and portfolio management lessons. And I would love to get my hand on that because so many great PMs have come out of there, including David Ott, including Tom Purcell, including Dan Sunheim, including Andreas Alverson, including Olson, I mean, literally, like, some of the best PMs ever have come out of there. Who else? Look, there are many. Baron Capital does a really good job with their letters. They're out there for free. You should read them. The guys put up numbers that are fantastic. He also has a conference, by the way, um, every year where he invites CEOs, and they're actually incredible. It's very thoughtful. Okay. Oh wow. Some good stuff here. Give me a second. I don't really read that many Substacks. I like Mike at Non-Gap a lot because he deals with compensation and management, what we call management conspiracy. I haven't read one of his in a while, though. There's some really good stuff out there, okay? I mean, we're in a period where Substacks are moving markets right now. And I think there's a lot of thoughtful stuff, but we're also in an inundation of content right now. So stuff tends to reach me when smart people in my network have asked me, "Hey, have you read this?" You know, I hear Tiger Global, by the way, just wrote their 25-year letter. Chase has been kicking ass and taking names for 25 years. That's Tom Brady like in terms of lasting in our business. It takes a lot to last in our business. Okay. This is a brutal, brutal, brutal fucking business. And Chase has been doing it and doing it well for a while. So I'm sure there's a lot of good stuff out there, but really it's you just have to get smart people to send it to you. Thoughts on how to approach AI as an intern? I think I covered it. Worried about it affecting my learning. Also worried equally about being uncompetitive without it. Look, you have to use the tools, right? Know how to use them, but do the analog training. Okay. Do you read for 1 hour per day? The other day I was at one of the Ivy Leagues, and I'm speaking to 100 people, and I asked, "Who here's read You Can Be a Stock Market Genius?" This one Korean kid who's probably the best investor in that school, but I knew him from before because he found me on LinkedIn and we've been working on ideas. He's like, "I've read it." One guy out of 100. Who here's read Reminiscence of a Stock Operator, specifically the annotated version by Paul Tudor Jones? No one. Who here's read The Letters of Warren Buffett? No one. Who here's read Noble Steinhardt's biography? No one. I literally listed close to 12 books. No one had read it. How is that fucking possible? Okay. You need books to understand historical context. And by the way, a $5 book, you can learn about a mistake and not make that mistake for millions of dollars for the fund that you work at. So if you're an investor and you're not leveraging $5 that becomes into millions, you're actually short that, right? You're short a negative vol. Okay. So it read, spend an hour. I'm more, it's funny, we have interns and for the summer when they come, they're mostly reading. It's like, when else am I gonna literally force somebody to read? Because when they leave into they don't fucking read anymore. And by the way, think of the advantages that you're gonna have just because you spend an hour per day reading. 1 hour per day. That's 365 days, right? You maybe read a book every 2 weeks. That's powerful, really powerful. I know I sound like a fucking boomer, but it's true. It's very true. Like no one reads anymore. And by the way, there's a problem in the investment business currently called the junior senior problem. A lot of PMs don't want to work with juniors anymore. And the reason why is the junior, even though he might use a tool, the LLM tools and can do modeling faster. I mean, guys are learning to model in freshman year in college now. I was at my alma mater the other day talking to the investment club, and this kid, as a freshman, was a better modeler than all my current analysts combined. Okay. But if you ask him, "Hey, what do you think the CEO of this company is thinking?" He doesn't know. He doesn't understand it. He can't use his mind's eye to read between the lines, to make leaps of judgment, to synthesize, to think about the competitive dynamics going on in the business, and he has zero recall. Why? Because he hasn't read. He may know, but he doesn't understand, right? So really, I'm not worried about your approach to AI as an intern. I'm more worried about you, you know, under doing what's called analog training. Bernardo, we are being flooded with AI generated content, traditional vehicles, there's LinkedIn and X. Some are good, some are really good, but it actually makes people less inclined to read. How would you adjust themes, frequency, depth of content to differentiate? Um, I use smart people as a filtering for great ideas, great content, knowledge, and great contacts, right? So it's really network driven. So, for example, if I wanted to meet Peter Thiel, I would literally go and read all the books that he's mentioned, and I have, right? If I wanted to meet a writer, like for example, a Sebastian Mallaby, who has actually become a friend of mine, and he just wrote a book on Demis Hassabis on AI, by the way, which is a must read. Sebastian is one of the world's best researchers, and he's incredible. He wrote More Money Than God. He wrote The Power Law, which are seminal reading for the investment business because More Money Than God explains the investment business, specifically the hedge fund business, and the Power Law really explains venture capital and the crossover funds and what advantages they have. Very powerful. So for Sebastian, I first read his book, then I read all his articles, then I read his pieces for the CFR, and then I approached him and I said, I just read your stuff. And I'd like to ask you a few questions. Oh, by the way, I'd like to host a dinner for you with my friends. And guess what? We had the dinner. I think we've had two dinners. We've done a bunch of Zooms together. But I use, who I want to meet and who is in my network. If I meet a businessman and he tells me to read something, I'll read it immediately. And I've mentioned this on Twitter, but we believe in inspectional reading, right? Which is a form if I don't have time to read something or I want to speed up my knowledge of something, where I'll take like a dozen books and read them like that on a daily basis, where you read them inspectionally. So inspectional reading is actually a book that's a bad example of this. Which is a book that's actually a good example. Okay. So I'm reading a lot about cognitive behavioral therapy right now, right? So inspectional reading, very important. You read the index, in this case, the quick start guide, right? You read that, takes you a few minutes. Then you go to the back and you read the index. And then you literally put a check mark next to words that you either want to look up after, words that you know, or words that frankly interest you. Then you go back to the front and you read the introduction and the foreword, right? You read that, also takes you 5 minutes max. Then you go to the back of the book and you read the last chapter. Right? By the way, in this book, there's resources, there's notes, read those as well. Anything that looks interesting, you note it. Oh, by the way, I forgot. Always before you start, if the book is a biography and it has pictures in it, make sure that you look at the pictures. And the reason why is it's a memory trick. We remember images literally 100 times more than we remember facts. So when you read a book that's a biography and you've seen the pictures, when you read about it, you'll remember those facts because you'll hang them in your mind on those pictures. When you see people that have great recalls, even if they don't understand what's happening, that's actually what's happening is they are hanging those facts on that thing. By the way, other than pictures, mental models, the reason why they're powerful, and my mentor Charlie Munger used to talk about them a lot. He used to say, uh, when you know a mental model, let's say like inversion, and you read a fact, if you think about it through inversion, you've now hung that fact on that mental model. So if you're trying to recall something, as you're applying the mental models in your mind, the facts, you almost download them. right? On their own. Okay, so after you've read the back of the book, you go back to the first chapter and you read the first and last page of every chapter, right? It takes you about an hour to do this, but you'll get the 20% of the book that gives you 80% of the value. Okay. I'm more concerned, and I think I'm in the minority, okay, of you doing that. Sorry, of you not doing that than playing with AI tools. Read, analog training, play games, okay, board games. There's a reason why the AI tools chose board games to train them on. Go, chess, backgammon, poker. Play those. Have that be your personal laboratory. Learn mental models. There's been some great mental models books. Read Charlie Munger's Poor Charlie's Almanac. Uh, I did a reread of it recently. Okay. Masterclass. Read it, understand it, apply it. Charlie sat there and gave all this information for free. By the way, this was edited by one of my mentors, Peter Kaufman. Study Peter. Very important. In our business, we are paid to learn, but once you have that knowledge, you have to turn it into changes in behavior because in many ways there is no learning without behavior change. Anyway, sorry, I'm flooding you with stuff and I hope it's valuable. Okay. What advice would you have for mid-20s analysts under scale long only fund? Should they keep as is or has the game gone too hard for these players? I actually don't think the game has gotten hard performance-wise. I think the game has gotten hard to raise capital. I wrote a memo on barriers to scale. If you want, leave a message on here or on my Twitter, and maybe I'll share it again. In the investment business, the barriers to entry are nil. You need a chip and a chair, as they say in poker. But the barriers to scale up, there's 10 of them that you need to breach through. And they act as a almost like a force pushing you down. And you need to know how to breach through it. In many ways, the things that you're going to need to breach through are leverage, capital, code, community, content that helps you breach through the barriers to scale. Performance, if you're a subscale, I could do my job, a telephone, a 10K, and a pencil. That's how I'm training myself to be because we've developed investment concepts and ways of seeing things that are differentiated enough. And by the way, it took me years. I suffered for fucking years to find an advantage. And really, it's literally in the maybe last 5 years that we found one, right? So, but the performance stuff is out there, doesn't cost a lot of money. It just takes time and understanding and new way of seeing things. But to raise capital, that's very difficult. Very difficult. Um, but anyways, let me just see. I don't think the game has gotten too hard. It just takes persistence, great performance, and knowing how to breach through the barriers to scale. Will you be able to have the lasting surviving across market cycles? That's why like what Ricky has done is incredible. For 26 years, he lasted. Um, and yes, he shut down, and we don't really know why he shut down. He mentioned the reasons. But again, it wouldn't surprise me if we saw a return of the king. I think Ricky's going to come back. There's better ways to express a point without it. I don't know what you meant, Marcus, but again, it's okay. If you, okay, regarding selection criteria, Dom Rizzo just had a great interview where he discusses criteria for tech investing. Any other active manager you recommend studying sector-specific criteria for? That Dom Rizzo piece is phenomenal. Phenomenal. You want to read, there's an old school tech manager that just wrote his new rules for tech investing that are very powerful. So Dom Rizzo in that piece, by the way, he touches on the importance of narratives and today's markets. Very important to understand what the hell he's talking about. Um, narratives. Let's step back a second. The market structure has changed. And we think of market structure as pre-08 and post-08. So in 2008, we actually believed that the market structure changed. So pre-08, what happened? Well, pre-08, the pods were smaller. Post-08, they're massive and levered. Pre-08, the commission dollars were much larger. So Wall Street could afford to invest in its analytical capabilities. Post '08 commission dollars are tiny, and analytical research has been decimated on Wall Street. Pre '08 passive was smaller. Post '08 passive is huge. Pre '08 quants and algos, decent part of the market. Today they're massive. Pre '08 retail owns something, a huge percentage of the total market. I think it was in the high 60s. Today, I think it's lower than 45%, right? Pre-08, we had prop desks, but then the government, after the great financial crisis, passed certain rules. There's no more prop desks. So the way to think about it is the pipes of liquidity have changed. You know, pre-08, we had something called valuation support. Stock would go down and people are like, yeah, I'm not selling it. It's cheap enough. But today, there's no such thing as valuation support anymore. If something is cheap, it's going to keep going down. Why is it going down? It's cheap. Market does not give a flying fuck that it's cheap. It's just going to keep going. Stocks don't go up because they are cheap. Neither do they go down because they're expensive, right? So if you're thinking about what is different in this market structure. Oh, I forgot. By the way, pre-08, social media, almost non-existent. Today, Twitter, Substack is moving stocks. So narratives are going to matter a lot more. And by the way, narratives, the tail can wag the dog. If the narrative is this company is not going to do well because of AI, not only do the investors see that, but the customers see it as well. So now the sales team has to go and fight that. But who else sees that? The employees see it. So narratives can cause a negative reflexivity the same way that narratives can cause a positive reflexivity. So I think Dom touched upon that in a masterful way. And I think it was somebody that tweeted about it. It may have been you, by the way, that tweeted about it, or you may have sent it to me, but it's very important. Sector-specific criteria. The other thing is Druckenmiller in his interview and Market Wizards talk about how in certain industries you have to know what moves stocks, right? So in chemicals in the old days, it was capacity. Stocks they were adding capacity, stocks would go down. Taking away capacity, stocks would go up in chemicals, right? I think that's the example that he gave. For banks, it could be something else. For consumer stocks, it could be something else. What drives stocks to move up? And the way that you find that out, by the way, is you have to speak to people. Gary posted recently about FOMO positions born of analyst work that doesn't have decisive output. How do you manage analysts to reduce your firm exposure to those ideas? FOMO positions born of analysts' work that doesn't have decisive output. I don't know what you mean by that. And I remember what I posted, but if you find the post posted, I'll take a look at it. All right, Evan. Buffett's insurance float and considering Bill Ackman's recent focus on Pershing Square USA and Howard Hughes Holdings, do you share the same end goal of permanent capital? If I can, of course. We're not at that level yet. Not even close, actually. Um, so let's step back a second. Um, we love long short. We love running money long and short. On days where the market is crapping out, most of the time my shorts are hedging out my longs losses, and I can cover some shorts and buy more of my longs with it. And then when it bounces back, we take advantage of that, right? We're one of the reasons why our turnover is fairly high is in market declines, we get to do that and kind of circle accelerated the way they run money. But we love that. The problem, though, is that long short has a lot of issues. Okay. And you have to know what those issues are and know how to fix them. Now, one of the ways to fix the long short issues is when you find an amazing idea, you need to do an SPV for the idea. So you run long short, you may own that position in the long short fund, but on the side, you do an SPV for it. And the reason why is one of the main problems of long short is your best ideas, you keep having to sell them on the way up. Why? Because you may have a 5% position that literally five baggers when the rest of your portfolio does so, but now you have a 25% position. Are you going to keep it at 25%? Well, that would be irresponsible. Why? Because eventually you're going to have one quarter where that idea goes down 50%. As the Lord is my witness, it will. Okay. Well, are you able to withstand a 12.5% drawdown? No. It's a fallacy to think that you're going to allow something to concentrate like that within a long short portfolio. I actually believe that for long only people, it's a fallacy to think that they're going to allow that to really expand and then long only because you will go through a drawdown, okay? You take a 50% drawdown, analyze the number of years that it takes you to get out at 15% annualized returns. Okay, it's very, very difficult. I don't like drawdowns. I fucking hate drawdowns. I don't like the way I feel in drawdowns. I don't like going through them. And that's why I love running long short, but it's also why some of our longs, as they do well, we sell some. But when we have something that we're highly convicted in, we park it in an SPV and we let it compound. Drawdowns are not. It goes through a drawdown, but we still believe in it. We hold through it for years. We've only done three of them, but that's going to be one of the ways as close as we get to permanent capital. If I'm lucky ever enough one day to have a vehicle of permanent capital, definitely. As of now, I think it's my little brother and best friend that's more likely to do so. He's a phenomenon that's half Jewish, half Armenian, and has the commercial instincts of both races in one person. He'll have a permanent capital vehicle, and hopefully, I own a piece of it. I've seen all the videos. I think it would be beneficial for all to demonstrate your process to one of your primary holdings, search process, investment thesis, outcome, lessons learned. Sadly, LCJR213, we cannot talk about current holdings, and we rarely talk about stuff that we've owned also in the past. It's not, by the way, because of secrecy or anything like that. If you study great content strategies, it's very rare that the investor discusses current ideas. Buffett almost never talks about his insights on a current investment idea and even a past investment idea. And part of the reason, by the way, is because you anchor to these things when you make something public. You literally trigger your own biases. We talk about process ad nauseum, hiring process, marketing process, investment process, and we try to teach that to people and our potential partners. What we know about hiring, for example, we think is highly sophisticated and is a competitive advantage. We teach it to people, but we rarely talk about ideas. But we leave certain clues here and there, So for example, thematic research is very important for us. Content strategies, very important for us. So for example, I'll talk about, I guess, one past investment. You know, this that you're looking at right now, this boomers to zoomers theme, when I was first learning it, I created a piece of content on it. And then I called the 20 smartest PMs I knew on a Zoom and said, hey guys, let me teach you this theme I'm working on. Right. And by doing that, in 2022, one of them says, hey, homie, if you think this theme is going to happen, you have to take a look at Robinhood. I was like, why? And he goes, do you think when these millennials and Zoomers are getting cash from their baby boomer parents that they're putting it in Fidelity? No. It's either going to be Robinhood or Interactive Brokers. And we're like, whoa, he's right. So we went and took a look, and Robinhood has been one of our best investments. Um, but there were other things. This wasn't the only thing happening, but this tailwind was one of the things that was pushing this business forward. And we want that. We want a geopolitical, political, regulatory, social force, dynamic condition that's pushing the business forward. I sat down with Barry Diller once and years ago, and I asked him, what's important in a business? He goes, what do you think? And I'm like, listing management team, a moat. He's like, no, 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 no. What matters is the trends that the business is exploiting. Is it on the right side of change? Is it on the right side of the trends? Because if you're a management team and you're fighting a headwind, if you can make a mistake, you'll get decapitated, right? Like a small mistake could be deadly. Whereas if you have a tailwind pushing a management team forward in a business, you imagine the CEO just fucked up. It's okay. There's more revenue coming, right? So we leave clues in terms of our processes. So for example, we take a theme. The first thing we do is we build a content strategy around it and we share it with smart people and then we see what comes back. That's a very important part of our process. Okay. Why? Because I start from the point of view that I'm a fucking idiot. Okay. That's the base that I'm trying to work up from. Right. And then once I have that, I'm like, how do I surround myself with the smartest people on this thing? And if they say jump, we go jump. If they say check this out, we go check it out. If they say, hey, be careful of this management team, we're careful of this management team. Okay. So there are things in our process that are differentiated and we've designed it to be so. But again, it wouldn't really be useful for our partners, for us that have given us money to share all of that. But we leave clues. The clues are out there. And I'm not being cryptic, by the way. It's unfair to our partners to share everything that we do. And by the way, let's step back again. A content strategy, you have to create a tension between what is disclosed publicly and what is disclosed privately. What we disclose publicly is very good, but believe me, what we disclose privately is even better. All right. Okay, this is not allowing me to do this. Some good questions here, by the way, and I'll go on for as long as you guys want. Okay. Would be useful to know how you think about sizing and portfolio construction in the context of a specific idea that I can talk about. Okay. We run a Jones model portfolio. If you haven't studied it, A.W. Jones came up with supposedly the ideal Jones model portfolio. And what that is he believed that the best way to run money was long and short. And that if you ran for every dollar of equity, 150% long and 100 short, that despite using leverage and having more exposure, that you reduced your market exposure because 150 minus 100 is 50%. So you're only 50% exposed to the market. But further on, he believed that if you were really good at being a stock picker, that you would earn the long short spread, meaning the performance of your longs minus the performance of your shorts. If you were really good a stock picker, for every dollar or that your longs would go up, if the business really sucked that you were short, it would go down $3. And actually, for a lot of Jones model portfolios, that's been proven out. Now, A.W. Jones was the father of the first hedge funds in the 60s and 70s. He had a bunch of disciples that left and that ran that model. And the most famous of those disciples was actually Tiger Management. Julian Robertson was a broker at Kidder Peabody, I believed, and Jones was one of his customers. And the legend is he used to go and meet with Jones and pepper him with questions about how to run money. And if you look at actually the Tiger Cubs, they all ran some version of Jones out there. So Lee Ainsley ran strict Jones. He ran 250. Steve Mendel, I think, ran a modified Jones where his gross exposure was lower and but still kept his net close to 50. Chase Coleman, Andreas Alverson, they all ran a version of Jones model, and I actually believe that Jones model fits my personality. Now, contrast that with running beta neutral, factor neutral, or market neutral. Now, that might be what fits your personality. I know guys that are really good at it, really, really good at it. Uh, but the kind of stocks you pick you have to be careful. So for example, if you're running beta neutral, but you're long Momo growth and you're short value stocks, good luck. I mean, that may have worked because value stocks suck right now, but the beta mismatch of your portfolio on a day where that shifts, you could lose money on both sides or in a deleveraging. By the way, the joke is in a deleveraging, your gross exposure becomes your net exposure. It's funny, but it's also true. You want to make sure, and this was one of Jones' contributions, A.W. Jones. He says that you want to be long businesses and short businesses that have the same velocity. That was his version of beta. So, for example, I like spicy longs. So stuff that might be heavily shorted, there's controversy, but the fundamentals are inflecting. And then the reason why I like those is portfolio construction wise, it hedges out your shorts because I'm short a lot of spicy shit, right? Radioactive garbage. And I like to match those that call it beta, but I like to use the term velocity. And beta, by the way, can be explained by the type of holders. So if you're long names with only institutional nerdy value types, and you're short names where retail gung-ho, Reddit guys are long, and you're short that, good luck. Okay, you're going to have all sorts of misbehaviors in your book, and you need to have portfolio construction that hedges that out. Now, how do you size positions? So, uh, first, you need to have what your this is the way that we do it. And again, it's not perfect, okay? But let's say we have a max position size of 8%, okay? And we have five st stock selection criteria that we think matter. So five things. So for example, for my first fund, the five things were business quality, potential for operational change, variant perception, timing, and valuation. All right. So I'll say it again. Was it a good business? Could the business get better? Operational change. What's the variant perception? What do we know that the market doesn't? What is the timing? Where is this business in its timeline? And what's the valuation? Right? And then we'd say, okay, you take a max position of 8% divided by 5. So 8 divided by 5 is 1.6, I believe. Jesus. Yes, I had to actually do that math. I need to check my fucking brain right now. So 1.6. Okay. So let's say it's a really high quality business. Okay. Now on that, we scored 1.6. Okay. Now let's say that the business isn't really getting better. It is, but not max. Okay, well, let's give that 1%. This for example's sake, kids. Okay. But now the very perception, yeah, there's certain things about the business quality that people don't understand. Okay, let's give that 1.6. Timing. Well, actually, they're having investor day in the next couple of weeks. They're going to explain what's actually happening, right? Okay, so let's give that a 1.6. Um, how about valuation? Well, the valuation is decent, but it's not really cheap. Okay, well, if you take 1.6 for business quality plus 1% for potential for operational change plus 1.6 for the variant perception plus 1.6 for the timing plus 1, okay, that's about a 6.8% position. Okay, now you kind of have a framework on what to size, on how to size a position. By the way, we rarely take a position above 8%. So for you, it may be different. Okay. Then what we then do is say, okay, we have a 6.8% position, but we have five other names that are sorry, let me step back a second. Once you have that 6.8% position and you have the stock selection criteria, now you actually have a criteria to reduce the position size if something happens, right? So for example, if something happens, you no longer have timing. The investor day happened, the stock is up. Should you be reducing the position size? Well, it's if timing is part of your stock selection criteria, yes, you should. Okay. But once, and by the way, so out of these five things, one of them usually is 50% of the value and the rest keeps falling down. So you should also do it for a power law distribution. So the first is 50%, the second is 25%, the third is 12 and a half, the fourth is 6%, and the fifth is 3%. And then you should always do also equal weighted, where you have five things that's 20%, 20%, 20%, 20%, and so on. Okay. But again, run it both ways. And the second thing you should do is, okay, you want to size everything at 6.8 because all your ideas are fucking great. Because guess what? You're an investor and we all have that problem. Now take all the 10 ideas that are your best ideas and compare them to each other and then dynamically reduce the position size if you have, let's say, if seven of your ideas, 10 of your ideas on the AI CapEx build out, you have a problem because you're really exposed to that one dynamic. I mean, if you're right, God bless you. But invariably, you go through a drawdown, you're going to be suffering, right? So you can dynamically reduce that. If your fourth idea is the best idea you have, well, you can compare that with the top idea and be like, why am I not bigger? And now you have a force ranking criteria. By the way, we this is the way that we our criteria for my first fund. We don't use those criterias anymore. I mean, we use parts of them, but it's not as important. But I think you'll know what I mean. Now, should you use Kelly criteria? We're not believers in Kelly. We think Kelly is great for quant fund. Kelly, if you're going to use Kelly, I would severely undersize your Kellys. One of the insights about Kelly criteria, by the way, is that a half Kelly gives you 75% of the returns, but with half the volatility of the position size. So Kelly is 2p minus 1 is how you get to the answer. So if you have a 60% chance of making money, Kelly says 2 multiplied by zero point 0.6 minus 1, and that's a 20% position. Okay, most young people don't take 20% positions, okay? You don't know your ass from your elbow. If you win, odds are you got lucky. If you lose, you're going to learn a lesson. So be most you should actually undersize your positions. But even I think a half Kelly might be too much for certain people. A quarter Kelly, probably better. Probably better. The other thing is crawl, walk, run as a PM, meaning a lot of people start the year, they're too aggressive. They're like gung ho, let's start the year big. And then they go through a drawdown. And then now they're forced to play defense for the rest of the year. Crawl, walk, run. Crawl to 8% performance, where you're like, you're leather ass grinder poker player, right? To 8%. Once you're up 8%, start walking. Loosen up a little bit higher position sizes. You have a margin of safety of being up, right? It's not that you're playing with house money. It's that you have a margin of safety. You're up 15%. Start running, right? Once you're up 25%, loosen up a little bit more. But what happens if you go from 25 to 15? Well, go back to walk mode, right? If you're down, go back to crawl mode. Adjust your position size. Don't start the year in the hole. Uh, uh, we learned crawl, walk, run by studying Druckenmiller and Soros. Uh, when these guys were up 40, that's when they went for it. Most people are up 40 and they get all defensive and they're doing prevent defense strategies. Whereas that's when Druck and Soros would literally open up. And that way of running money, if you're Druck and Soros, if you have an advantage and if you're sophisticated, is the way that we believe in running money as well. I am not Druckenmiller. I made the joke once that to be Druckenmiller, you have to do what his parents did to him when he was 9 years old, which is they grafted a third testicle onto him, which is why he has the balls to take those position sizes. Unbelievable. Um, the legends, I actually don't believe them anymore because I'm like, there's no way he did that. And then I'll ask somebody, he's like, no, he did it. But anyways, okay. So that's the general concept of momentum, right? A stock doing well tends to do well, hence why cross-sectional strategies work correct. By the way, momentum has become a bad word for value investors. It's like, you're a momentum investor. Blah, 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 blah. Like, I'm sorry. How do stocks go up if they don't have any momentum in them? Both business momentum and stock momentum. You know, like why do you want to own a name that has no momentum in it? It's like everybody, like no one knows about it. No one's buying it. Yet you're so lucky that one day somebody's going to realize the value. Value guys tend to hate when their names become popular because it makes them nervous. But yet, for your stock to go up, it needs to have a certain level of popularity eventually. What's my opinion on the match rally? No idea. I thought it was an obvious long because terminal value is too depressed by everyone's opinion of cash flow durability, up around 50% ADO last 2 months. I actually don't know. We don't cover it. We've covered other dating names and made money in dating names, but Match, we haven't. Felix, you're welcome. Appreciate your insights immensely. What system do you or other great investor you observe have in place to broker intros within their network at scale and not like a one-off? So, great investors, one of their unseen habits, I should probably do something like this, by the way. The unseen habits of great investors. One of the things that they do is they create networks. See, networking is not me meeting somebody and giving him my business card. That's just a one-on-one hub and spoke network. They're actually not the most valuable ones. When sociologists study networking and tribes or businesses or groups of human, there's three types of networks. There's distributed networks, there's hub and spoke networks, and then there's a third one, which names I forget. But what matters is you have to be in a distributed network. And the way that you do that is whenever you meet somebody that you really respect and you want to build a relationship with, not only should you stay in touch with them, but you should connect that person with somebody else in your network. Always. I'll say this to groups of thousands of people, but very few people do it. Do you know why? Because we all want to hog our best relationships to ourselves. Because I want to know this person. I don't want somebody in my network to know this person because maybe he might like that person more than he liked me or something like that. Or maybe they'll go off and create great businesses together and they won't even call me. And again, that's a scarcity mentality. People that know me well know that if they call me and they say, "Hey, I need to do this. How would you do it?" I'm like, "I don't know how, but I know a guy that does." And I'll introduce them and let them go. Please become best friend. Fucking get married, start businesses together. Please go ahead. But guess what? By doing that, the probability of great opportunities, great knowledge, great contacts coming back to you increases. It really does. If you look at great opportunity, well, how did that investor get that opportunity? You're like, oh, he got it from that guy. Well, how did he get it from that guy? Well, he introduced that guy to that guy one day, and then that guy told him, and then told him back. And sociology, that's called triad creation, right? Like for example, who is the guy that introduced Charlie Munger to Warren and created the best business partnership that's ever lived or ever will live? How come we don't know who that guy is? Pretty powerful, right? The you need to be doing this consistently. Now it gets even more powerful when you become a host. I like to host. Bring together 20 people that don't know each other at a dinner. I'll pay for it. Or even, we have like five guys take out their credit cards and then four people each need to go and pay Venmo that guy, right? And we bring them together. They don't know each other, but you bring good people together and then you'll see the guy like, hey, you know that thing you were talking about? Mikey here solved it. The two of you need to get together and go solve it. Go ahead. I've created best friends, business partners, whole management teams together by doing that. And it comes back to you. You got to give what you want to receive. Have an abundance mentality and create a networks by connecting people in your network that don't know each other. Having gatherings, you know, going to conferences is great. But if you're at a conference and you meet somebody and you ask him what he's going through, and the guy happens to mention a problem, you're like, wait a second, I know a guy that can help you solve that. Take that guy, introduce them together, let them be. Believe me, it comes back to you in more ways than one. Is there a repository of investment memos free online? Yes, of course. Danielle, a Value Investors Club, must read, must read. If I were you, I would read. By the way, you guys know what value line is? Give me a thumbs up if you guys know what value line is. Um, it's very important to actually go to the library, or if you have the cash, pay for it, get a value line, and every day read 5 of those pages and study them. Hell, you know what? That's too much. Read one of those pages and study it. There's an amazing investor. Let's just say his first name is Caleb. Uh, One day I was talking about a stock and Caleb knew it. I'm like, Caleb, how the hell do you know about this fucking stock? He's like, well, I've read about every company in that sector. I'm like, there's like 600 companies investors. He's like, yep, I've read about all of them. That guy's a moneymaker. Okay. So it's much, I'd prefer if you did that, read Value Line, then go and read play with the LLM tools. Okay. Do you have any advice on how to analyze the notes to jewel financial statements, aka the qualitative jewels? No. You can't really analyze notes to financial statements and get the qualitative stuff. I mean, well, you can derive, if you've read Financial Shenanigans, if you've read other books on what to look for in the accounting and understand, day sales outstanding and other things, it can tell you a lot about a business. You have to understand that a 10K or a 10Q has been very lawyered up. The management team gives it to a lawyer, and the lawyer's job is to protect these guys from their own issues. So they tend to redact stuff and only disclose stuff that really they have to disclose. Trust me, they're not going to disclose something that's important that they don't have to disclose, okay? It hasn't escaped management teams and lawyers that they can do that. On the contrary, the legal industry has gotten really sophisticated at protecting management teams now from shenanigans. So really, I wouldn't necessarily suggest that you go in that direction because again, the quantitative tools are actually going to do a pretty decent job of doing that. But what they're not going to do a decent job of is you visiting the company and understanding the culture. Like, oh, the CEO is in the corner and has his own dining room and doesn't interact with the employees. That's interesting. He has his own parking lot. Really? He has his own parking space. And you're like, you're talking to him and he's very arrogant, and even cocky, and he didn't understand the entrance. Like that's things it's going to reveal qualitative things that are won't be in a 10K or 10Q and that the machines will miss. Business quality, product quality, management quality, competitive interactions, competitive reaction. These are all things that the algos, the AIs are going to have a hard time seeing. Those are the things you have to become a pro at. Not money. Reach me uh, on LinkedIn. Send me a LinkedIn message. My personal email sometimes is useful, but I'm kind of getting deluged there. So really send me a LinkedIn. How do you balance life with work while pursuing excellence, with becoming the best while keeping your body, mind in peak condition? Great question. Sitting at the desk all day is pretty bad for you. Absolutely. Uh, you need to work out hard. Um, Managing stress and you need to work out to be able to do that. one of the secrets of great investors, if you meet them, is they all have an outlet for stress and how to minimize it. But a few tips there. Um, Never bring a bad day home with you. If you've had a bad day, go to the gym, get 20 minutes on a stationary bike or a treadmill, and try to keep your heart rate at 80% of its max for 10 minutes to 20 minutes. That resets your emotional system and clears out all the negative chemicals. Because the worst thing that you can do is bring that stuff home. You'll take it out on your family, you'll take it out on your friends. Believe me, like we've all had bad days and taken it out on other people, and you don't want to bring that stuff home. And more importantly, you don't want to sleep with those negative chemicals in your body. Okay? Very important. Second, do the same thing if you've had a great day. Positive chemicals fester in your body in negative ways, just like negative chemicals do. Okay? They make you cocky, they make you arrogant, they make you complacent. You've had a great day, get on a treadmill, try to clean it out of your system, and it will seriously help you manage both the ups and downs. Second tip for work-life balance: minimize or cycle out of hyperstimulants, pornography, weed, psychedelics, caffeine, nicotine, social media. Be very careful. By the way, I'm talking a big game, but I am as addicted to Instagram as like I know we own the company and everything, and my excuse is I'm checking how the algo is doing. But no, I am addicted to Instagram, and I'm also recently single, and my friend calls Instagram Shopify for alpha males, and it's probably true. But I try to cycle out of my hyperstimulants. You know, I get in and out of caffeine. I get in and out of social media. I try to clean that stuff out, right? Very important for you because the hyperstimulants make your lows much lower and your highs much higher. So you're constantly going through this up and down stress wise. And if you look at guys that don't last in our business, one of the reasons is hyperstimulants. Third is your personal relationships. Who you marry, very important. The even though uh the woman that gave me my son, and that's the mother of my child, one of the most important people in my life, one of the most remarkable people in my life. Your parents, very important. Your friends, very important. Try to spend as much time with them as possible. For if you only have work friends, you don't have social friends, try to balance that out. Very important, by the way, when you're younger, to take trips together with your friends. So, for example, I try to make it to a different country every year, right? And I bring friends along with me. In January, I'm going to Australia for the first time. Okay. I have friends I'm going to meet there. I have friends I'm going with. I'm going to be at a tennis tournament. It's literally going to be 2 weeks of me being the extroverted little whore that I am, right? But I'm going to get to know the country, get to know the culture. I'm visiting companies. I'm doing all sorts of things while I'm there with friends. And it's called a compound experience where you experience things in a compound way, both social, learning, financial even, and it's all together. And also, I'm going with my cousin, who's probably the best connector I've ever met, because while hanging out with him, just good things happen. You meet business people, you meet everybody. So part of keeping work-life balance is that nutrition, learn to eat. Actually, you know what? Let me talk about something that's a bit of a pet peeve of mine today. Um, sauna is very important. Okay, but a few tips. One, Don't do it more than twice a week. Your body actually, if you do sauna right, you need at least 2 to 3 days for your body to recover. Okay. So if you do sauna right, what's happening is you're doing it maybe 4 sessions of 15 minutes. So 15 minutes, you get out, hopefully get into a cold plunge or take a break, go back for 15 minutes, and then on and on. It takes 2 to 3 days for your body to recover. Now, you have all sorts of these charlatans, for example, that are kind of telling you need to ice your testicles if you're a man in the sauna. Don't do that, okay? That actually stops the positive effects of sauna from happening. Sauna is very important for stress. Very, very important. And the reason why is a lot of the stress chemicals, when they go through your body, they actually go into the lower part of the epiderm of your skin. And sauna helps seep those out. It's one of the reasons why people that do sauna are actually de-stressed. And it's very, very powerful. Don't do it more than twice a week. It's too much. I know guys that do sauna 4 or 5 times a week. You're causing more harm than you're doing because you actually need the recovery time. All right, let's keep going for a little bit more. Andy, I appreciate the question. You can't find my 13F because I'm below 100 million. And even when we get above that, we'll probably do it through a holding company where you won't even know that it's us because I don't really enjoy. I think the hedge fund industry has become too transparent. If you're playing poker, is it great that you're disclosing the cards that you're playing as you're playing them? I mean, it never made sense to me. Do you have books or PDFs to read for understanding predator-prey dynamics? Great question, Jackson. You mentioned Web 1.0, 2.0, and 3.0. Explain the transitions using predator-prey dynamics. More info would be powerful. There really isn't. Well, there is one. Um, Read the book From Predators to Icons. Okay. So From Predators to Icons is a book that was written by an academic and a French academic, by the way, and then translated by another academic into English and talked about how the best businessmen in the world were actually not risk takers. That to break through what and what they broke through, they actually acted as a predator. They actually uh, saw a business that was weaker and through a predatory way took advantage of that weakness to take it over. And despite Michel Villette being clearly an academic socialist, he analyzes it from this perspective and actually shows you, like, holy shit, they were predatory the way that they behaved. And then over time, to kind of whitewash that history that they were these fucking sharks, they started acting in an iconic way, where they start donating to museums, being teachers, and so on. And really, to understand the predator prey dynamics, this is probably the only book that I've seen that does a really good job of that. The second thing you have to study is ecology. So one of the first places I learned predator prey dynamics was studying a pond. If you look at a pond that has, let's say, certain class of fish in it, what you actually notice is that the top fish sometimes feeds on the middle fish sometimes feeds on the bottom fish. And, they have this fairly stable predator prey dynamic, right? But then what happens is these ecologists, to fuck with the pond, they introduce another predator in there. And then what they've noticed is that immediately the top predator starts fighting the new predator. And then eventually they get tired and they're like, you're really hard to beat. So what do? They turn on everybody else. Those two predator goes after the middle guys. And then the middle guys are like, what the fuck is happening? How do we survive this? And instead of fighting the top guys, they actually turn on the bottom guys themselves. And then you get what's called an ecosystem wipeout, where they just wipe each other out until it balances again. And then the predator prey dynamics go back. Now, if you think, what the fuck is Unk talking about? He's talking about a pond. And what does that have to do with business? Well, let's analyze what happened in sports retailing. You guys know who dominated sports retailing? Dick's Sporting Goods, really. Then who entered? Amazon. Literally, Genghis Khan entered sports retailing. And what happened? Dick's armed up. They started replicating a lot of Amazon-like strategies to fight Amazon. And then both those guys realized this is going to be hard. So what happened? They turned on everybody else. So they wiped out Sports Academy. They wiped out Models. They wiped out all these other sports chains that people are like, what happened to those things? Predator prey dynamics, right? So Internet 1.0, Internet 2.0, Internet 3.0. Very important to actually understand what happened. And by the way, I have to thank my buddy Douglas Wirtz that actually explained this to me. Um, he's at Millennium and he goes, if you study Internet 1.0, you had Yahoo and GeoCities. Yeah, the predator prey dynamics were okay. Okay, these internet things they're really nice and cute. But then Internet 2.0 happened. Google, Amazon, Facebook. What happened to the predator prey dynamics? Well, they accelerated, right? Newspapers down, advertising agencies down, Yellow Pages destroyed. Who's ever even heard of Yellow Pages company anymore? And so on and so forth. But now what's happened since 2023? We have Internet 3.0, which is AI and blockchain enabled internet. And what you'll notice is that in Internet 3.0, the predator prey dynamics have accelerated. Internet 3.0 is not only wiping out traditional businesses, but in many ways, they may wipe out Internet 2.0 companies as well. And when you look at an industry, if you want an edge at it, one of the things that you need to do is understand the predator prey dynamics. It's very important. There's always weaker players getting eaten up by stronger players. And more importantly, the management teams never disclose that stuff in a 10K or 10Q. Yeah, they're not going to put a 10K in a Q. You know what we're doing? We're wiping out those guys. That's not going to happen. And by the way, the prey also is never going to say, you know what's happening to us? We're getting our asses kicked by those guys. That's never going to happen. So as an analyst, that's what you have to be good at understanding and analyzing. Jackson, I hope I explained it. Please share the Bears memo. We'll see, Timur. Before the SP5 was going up on wartime, these days market don't like the war, so it sells up bad news. So my question is, how the US will push the market in wartime? I need extra ideas. I have no idea, homie. One thing I'll mention though is if you look at the war and the problems that it's causing, the United States is actually fairly well insulated from those problems. So we may get a situation where if the war gets worse, other markets will sell off, and that capital is going to be looking for a home, and then it might come into the US market. I know it's counterintuitive. And again, I'm not in the advice business, but it's actually a scenario that we think might happen. I mean, by the way, we don't make money in those kinds of prognostications. Our goal is to get great businesses that are getting better on the long side and short businesses that are getting worse on the short side and having it right. Every once in a while, we have a macro insight because we live by the saying, if you don't do macro, the macro does you. And we respect the macro, but it's rare that we have one. But if how will the USA push the market in wartime? I have no idea. I don't know. I know that Trump likes to play the market like he's playing a Stradivarius. Um, I don't know. How has the rise of passive investing affected your approach to security selection over the past 20 years? It hasn't. What percentage of total equity AUM will be active? No idea. By the way, it's not, we actually look at businesses sometimes and say, hey, this thing in 5 years will be in the S&P. The somebody told me about a great investor once that one of his criteria is he studied the S&P selected stocks and then look at what these businesses looked at 5 years from now and only looks for companies that are pre-S&P and looks at that. It's not a bad strategy. But the rise of passive, we love it. We play the conditions on the field, homie. I don't complain about passive or anything like that. I adapt. My goal isn't to have an opinion of whether it's good or bad. Uh, uh, the our goal is to make money. If it's good, we take advantage of it. If it's bad, we take advantage of it. But whatever. Texas exchange launch. Will this ultimately renews? I have no idea. Stock narrative in the short term matter. Long term, it's all about earnings growth. Also good. Also true. You can find the Don Rizzo interview, Danielle, in on Twitter. Is your little brother into stocks as well, like you? Nope. I have a brother that's a bodybuilder, two brothers that are not. I have a brother who's a politician. I have a sister who works for LVMH. So no, not really. I was a stock jockey as soon as I was introduced to it. I fell in love with stocks. Literally did. And you have to be in this business. Paolo says, started reading Seven Cents, recommend last time. Excellent book. Dixon, old friend. So good for you to inspire. Where's your family? You should be spending time with them. Maybe talk about how you're balancing time between work and family. My family is currently on a trip. I'm joining them soon, Dixon. Airborne anti-submarine warfare, Michael again, per excellent. Jasipando, excellent suggestion. Um, one other book to read on that. There's a book called Military Misfortunes. If you want to study predator-prey dynamics, it's important to study the military. Also important to study sports like the NFL. We spent a long time studying the NFL. I call the gift that keeps on giving because we've either met NFL team owners, coaches, players even, and we'll explain something and they're like, oh, it's like that time I did this. And now we have a mental model of one of our business principles applied to something else. And the NFL, for example, we studied um, uh, hiring. How does the NFL select talent? Very important to understand talent selection in the NFL. Vital, okay? Vital, vital, vital. Um, like Bill Belichick, for example, has a financial way of valuing a player. Why don't we have that in the investment business? What are the criteria that he uses? What are our criteria in the investment business? We've actually replicated that. Pretty interesting. What's our average holding periods for longs? It ranges. There's stuff that we've held for 8 years. There's stuff that we hold for a week. There's stuff that we hold for months. We don't believe in playing in one temporal playing field. There are guys that are only short term. There are guys that are only midterm. There are guys that are only long term. We like all three. There's stuff that I'll hold forever, but it won't be as big a position size. But then it'll be smaller, but then something is like, whoa, no one understands this, and it will make it bigger. So the liquidity is the most beautiful thing in the world. You have to learn how to leverage it. Um, I think it's vital to be able to do so. Look, Ali, I think the CFA. It's excellent. I had to take the CFA once. I owned a piece of a brokerage firm years and years ago, and I had to take the CFA to be able to do so. And I learned a lot doing it, but it's not. Sorry, I don't have a CFA. I had to, excuse me. I was mistaking a CFA and the Series 7. Excuse me. CFA can be great education, but I know plenty of money makers that never have taken a CFA. It's fine. It's fine, but I know plenty of guys that are amazing analysts that don't even know what a CFA is. Uh, Learn analytical skills. There's five main analytical skills. I was talking about that on 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 Twitter the other day. The first skill is uh, read between the lines. Okay, you're reading a 10K. The CEO says, "I'm doing this," and you're reading between the lines. You're like, "That's what he says." This is what he says he's doing, but what he's actually doing is this, and here's why he's actually doing that, right? It's much more important to be able to do that than to be able to have other skills. Uh, uh, the second is making leaps of judgment. Okay, so a leap of judgment is you look at a company's sales team and you're like, these guys don't know how to sell for shit. Something's wrong. And then you're like, oh, there's a problem at the board level. And somebody's like, how did you make the jump from the sales team to the board? Right? That's a leap of judgment. The third is recall of past situations, right? So have you studied other businesses? Like, for example, did you study Walmart to then understand Amazon? Did you study Sam's Club or Costco to then understand Amazon? What is the link between the two of them? Right? So recall of past situations. The fourth is understanding strategic interactions between companies, and you can do it in your mind. Meaning like, this company is doing this, but if I was that CEO, this is what I would do in return. And then this is what that guy would do. And then literally you're visualizing things, the strategic interactions in the ecosystem. And then last is synthesis. Are you able to synthesize all of that into a memo? The CFA might help you to do that, but I've also seen certain things that the CFA teaches that have nothing to do with money making. Um, so, I'm not necessarily a fan. Because somebody has a CFA doesn't mean that I'll interview him and think he's a better analyst. I met some pretty great analysts that have CFAs. I also met some great analysts that don't have it. So do I like blackjack? How does blackjack and poker help you investing? It helps a lot. When I was a kid, I was invested in a blackjack team that did actually quite well, and we learned a lot doing that. Um, but also one of my first lessons was over a blackjack table. I was 14 years old, and I just read Beat the Dealer by Ed Thorpe. And my family used to vacation in Dominican Republic because we're Haitians, and my family was exiled from Haiti in 1986. And we still like the islands, so we like to go to Dominican Republic. And I had just read Beat the Dealer, and I've learned how to count blackjack, blah, blah, blah. And I go to the table and I'm counting cards and I'm up a certain amount of money. And then I get a tap on the shoulder, and it's this big guy, and he's like, "Come with me." And I'm like, "Well, that's my money." I'm like, "Yeah, take your money with you." And I go, and they bring me to the office of management. And the CEO of this casino company looks at me, he's like, I know your mom, right? And I'm like, "You do?" He's like, "Yeah. Like, I've seen you since you're 2 years old, blah, blah, blah." And he looks at me, he goes, "Do you think I'm in this business to lose money?" And I go, "What do you mean?" He says, "Well, turn around." So I turn around, there were video cameras everywhere of every table, and he's looking at it. He's like, "Did you just read a book on blackjack?" He's like, "Yeah, I did." He's like, "Well, you're just like your grandfather. You like to read." Okay. And I go, "Yeah, it's true. I do." He's like, "Well, do you think with your little Beat the Dealer book, you're still going to be able to beat me?" And I was like, "Oh." And he goes, "You want to be the house. Always be the house." And for me, that's a lesson that stuck with me forever. And that actually came from blackjack. Would it be wise to all in into a single sector and do write-ups with the objective of finding a mentor when just starting out? It is, but you better make sure that it's a sector where the lessons are applicable to other sectors. As a PM, how does your social life in New York consist of? For me, my true passion for market is get to compete to get girls. Amen, brother. Wanted to ask what life successful looks like, PM looks like in New York. When you're younger, pretty much that. The problem is you get to your 30s and you can no longer keep up energetically like you did when I was younger. I mean, when I was younger, I'd be 25, I'd go out till 6:30 a.m. with my best friend, roll into the office at 7:30, work till late at night, take an hour nap, and then we go back out again. You guys get into your 30s, you really can't do that anymore. One thing I would suggest is um, people don't host anymore. They don't have dinner parties at home. They don't call 20 people and say, "Let me introduce 10 people in my network to each other." You want to have a great social life in New York City, whether dating or otherwise. Give what you want to receive. Take good people and introducing them to each other. It'll help your network, it'll help your social life. Um, Being single, one of the things that I do is if I meet somebody and the person isn't, let's say, my type, but I still like the person, I'll introduce her to somebody in my life that is also single. And that way you create a triad. If they like each other, they like each other. If they don't like each other. But liking to compete and getting girls, my kind of guy. All right. I'm only taking it because the private bank I work for has biased hiring PMs with it. Totally from ball game in the hedge fund space. Oh, I got you, Jacobs. Of course, it makes sense. The if you're a private bank, clients want to know that you've taken it. It's fine, and you may learn something, uh, but be careful because there's a parable that matters a lot in our age, and it's the parable of the fisherman that walks into the fishing store and behind the counter, he sees bait that's purple, bait that's rainbow colors, bait that circles, bait that goes up and down like this. Literally the most sophisticated bait that you've ever seen. And then he tells the old timer behind the counter that's selling, he says, "Hey, do fish go for this bait?" And the old timer goes, "I don't sell to fish." You know, does the stuff that you learn actually help you make money? Does the bait that you use actually help you catch fish? The goal is to catch fish. The goal is to make a shit ton of money with very little risk. Does what you learn help you do that? If it doesn't, drop it. Credit investing as a career, it's fine. If you've done it the last 30 years, you've done very well. It's not for us. Um, I know plenty of people that have made a lot of money in all sorts of credit. I like the game of equity investing. By the way, having said that, uh, at some point in the next 5 years, we're about to go through a credit cycle. Um, and there could be an explosion in the cost of capital to the upside. If that happens, you'll and we're able to earn equity-like returns owning credit, yeah, we'll be there. We're very opportunistic. But beyond that, you have to be very, it just doesn't turn me on. If you're the kind of person turns on, go for it, please, by all means. The I know guys that have done very, very well in credit, way better than I have, way, way better than I have. But me for investing, I go to what turns me on, and I love equity investing. We invest in credit when it gives like equity-like returns, but again, that's very, very rare. By the way, we've actually done quite well shorting credit my entire almost my entire career, but again, it's very rare. It's very, very rare. The If you start your credit career at a time when credit has crapped out and all that stuff, that can be great. The problem is once credit spreads tighten again, are you going to be able to evolve and go into other fields? Maybe you can. Anyways, we've gotten to the end of the questions. I've stayed 2 hours and 20 minutes with you guys. I hope you guys learned a lot from it. I think we'll be able to do more of these. It's helpful for me to see the questions that people ask. It's helpful for a content strategy. A lot of stuff that we're thinking about. One of the first things to kind of help our thinking is to share it with an audience. I may share this, I may not. We don't know yet. If you guys want the Bears to Scale memo, let me know on Twitter or LinkedIn or wherever, and I'll share it. A lot of our internal memos we don't share for a bunch of reasons. My lawyer will strangle me if I share some of them. Um, but anyways, hope you guys learned a lot, okay? Be good. And again, happy hunting.